Good afternoon and welcome to the Mutual Fund Show. It's Wednesday and your appointment with me when we talk about all that you need to know about mutual funds. Last week, we went into basics. We spoke about how do people get to where they are. I mean, essentially trying to explain to you the meanings of some of the key terms that are used. Now, a lot of people told us that we know the meaning of SIPs, but hey, what are mutual funds? Little did they know that SIPs form a part of mutual funds. So what we're deciding to do today is try and explain to you what are the meanings and what are the advantages of 2 or 3 key terms that are used quite frequently by experts across, well, frankly, across the world, but across the country as well. Systematic investment plans, systematic transfer plans, and more. Just a quick update here of how an SIP or a systematic investment option would be really beneficial for investors. Now, this took me by surprise, but there is data to back this. Bear with me on this one. Say you started buying gold around the Dhanteras time. It's auspicious to talk about gold buying. Let's say you started buying gold since 2000. You bought, just consider this side of the table right now. You bought 10 grams of gold every year. Every year at a particular date, आपने बोला 10 ग्राम gold खरीदना है. So you ended up buying 170 grams of gold. The total investment that you had to do over these 17 years, 2.75 lakh rupees. The average cost per 10 gram of gold that you bought for all of these 17 years was 16,208. Now, that value is about 5 lakh rupees. Not bad, but here's the difference. If this 16,208, which is the average cost that you had to incur over these 17 years, if you had bought gold worth 16,208 every year, instead of buying 10 grams of gold, you would have ended up with a corpus of 8 lakh rupees, and the average cost per 10 gram would have been 10,179. 10,179, substantially lower than the average cost of 16,208 if you actually ended up buying 10 grams of gold. What does this tell you? If you indeed indulge in systematic investing, as magical as it sounds, it could actually result in you reducing your costs or increasing your returns, or actually, matter of fact, both. Let's talk about the man who gave us this data and talk about this particular magic, as I call it. Vijai Mantri of Buckfast Financial Advisory Services needs no introduction, joins us right now on the show. Vijay, this was quite stunning. I mean, when Jayesh gave me this data, it took me a few minutes to realize the importance of how simple changes in investment behavior can lead to such astronomical differences.
Actually, that's right. SIP as a product, we take it for granted, that systematic investment plan. It brings discipline, it brings certain sort of a way of investing, it brings system in investing. But a lot of people don't know mathematics behind it. How does it work? Yeah. That's why it is known as the 8th wonder of the world. And what is the 8th wonder of the world? It's a very simple thing to do. Buy more when the prices are low, and buy less when the prices are high. When you do SIP, like in the illustration which we showed, if the gold price was 4,000 rupees and you're buying 10 gram, you're investing 4,000 rupees. When the price was 29,000, you're investing 29,000. So what end up happening, suppose you buy a fixed quantity of gold, or you can take illustration of fixed quantity of a share. You say, I buy a X company's 1 share every month. Instead of doing that, you say, I'll buy a fixed amount. So when you do that, when the prices are lower, you buy more quantities. Yeah. When the prices are higher, you buy less quantity. And this has happened automatically in SIP. And that is the reason that SIP generate huge wealth for the investor. We have mutual fund data for last 20 years in India, 20 years plus. In some of the fund, 10,000 rupees SIP has created a corpus of more than 6 crore rupees. Wow. And because of this formula.
Because of this formula. Now, you know, I remember one of the earlier shows, Vijay, that we did, one of the financial advisors, Harsh Roomtar, or one of them had come in and he said, I don't know if the statistic matches or no, but he mentioned that if you've taken any SIP across any fund in the last 15 odd years, the minimum return that came into an SIP was about 6%. The maximum returns, of course, went on to whatever the numbers may be. And that's quite stunning as well. Instead of thinking of a fixed deposit or anything else, just start an SIP, and this magic of compounding or this magic of low cost averaging takes care of the returns.
Absolutely. all of us know theoretically that equity delivers the best possible performance over a longer period of time. So we know the destination. If you hold equity for longer period of time, you will create large wealth. But the problem is journey is not very peaceful. It is very volatile.
Right.
Now, what does SIP does? It makes volatility works for you without you being aware about it. It's like someone waking up every day 6 o'clock in the morning and running for you. You don't have to run.
How awesome would that be?
That's what SIP does for you.
Yeah.
Okay.
Yeah, that should be really, really interesting. In fact, a lot of you might be wondering how does mutual fund investment relate to this? Now, the example that I showed you in gold, yes, it is Diwali, so you would want to probably think of gold. If you didn't want to think of gold, but if you want to talk about mutual funds, Jayesh Khilnani has this very interesting insight on how the systematic way of investment would have mitigated the volatility in the market. He's using the example of one of the oldest Nifty index funds. Jayesh.
Yes, Niraj. So I looked at the principal index fund, which has an inception date of as far as 1999. Now, this is one of the oldest funds, or rather the oldest fund that tracks the index Nifty. So now, what I did was similar to the gold example that you showed. So I considered that you buy only 100 units every year. At the end of the calendar year, the last trading day, you simply go and buy 100 units. So what it actually translates into is that at the end of these 17 years, you would have accumulated about 1700 units at an investment of just over 50,000 rupees. Now the average cost per 100 units translates to 3121 rupees, and the current value as per today's NAV is just over 1 lakh rupees. Now, similar to gold, what you showed, if I convert this 3121 into an SIP, that is, mind you, a yearly SIP, how do the numbers look then? Let's have a look. So, the same thing if I do, I buy 100 units or rather I buy 3121 rupees worth of the units. So, how does the actual investment look like? So, the same total investment remains the same, just over 50,000 rupees, but your average cost has now come down to only 2,075 rupees. So, that's the huge difference coming in, and the current value has shot up to as much as 1.73 lakhs. That's a 50% increase from what the number was in the earlier slide. Now, remember that this is a yearly SIP that we have done. So, you can imagine what a monthly SIP can do going for you.
Well, Jayesh, thanks a lot for that. Thanks for giving us that update as well. So you saw that. We used that example in gold. We used that example. Vijay spoke about the example being across stocks as well, I'm sure. But in an index fund, it comes up to be as fruitful as well. Now, Vijay, is there any study, I don't know if there is, I'm just shooting this out of the dark at you. Is there any study which says that an SIP of a particular tenor could be more beneficial than the others, or let's not go too much into that into those lines, just do an SIP, whatever the frequency may be?
Exactly. The longer is the better, that's what we keep saying. So whenever you think of doing SIP, I think your investment horizon has to be minimum 7 years period. In 7 years period, whenever the market goes down, you should pray the market to go down if you are a SIP investor, because at that time you're going to buy more units. Though that particular moment could be really painful when you see NAV going down, your portfolio value is going down. But what you need to think is that when you're getting bad price, you're getting large number of units, you're getting more value. There's no better explanation of price and value relationship than this. When the price is bad, you're getting better value.
Yeah.
Okay. So if the market is more volatile, which is the nature of the beast, market would always remain volatile. In the volatile market condition, the SIP does wonder to you, and the longer you go, you make power of compounding also works in a favor. So as I explained to you, if you have a 20-year horizon, if you ever invested for 10 years, 15 years, 20 years, people do recurring deposit, people do invest in real estate, people do invest in gold. If they invested same kind of money in equities, then the kind of wealth they would have created is unbelievable.
Okay, now let's try and explain to people the difference between the systematic investment plan versus lump sum investing, as also a systematic transfer plan versus lump sum investing. Just before we get to that though, Vijay, would you care to explain how would a systematic transfer plan work and what kind of investors would it be beneficial for?
See, SIP systematic investment plan is basically you are planning to invest for future cash flows.
Right.
So you don't have a cash flow right now, but you know you are pretty confident that on regular basis you're going to get that kind of cash flow. So you plan for that investment in advance. So that
Young people like me.
Young people like you, young people like me as well. So we could do that. So there's a systematic investment plan. The second alternate is that you have a large sum of money available to you which you would like to invest. So that is called lump sum investing, one-time investing. Rarely it happens in anybody's life that you have just one-time investment, you're doing that one-time investment. But once in a while you keep getting chunk of money. For instance, now the bonus season, people will get bonuses. So what they should do about it? So the systematic transfer plan works very well for them. So what is systematic transfer plan? You have a large pool of money available to you. You park that money in a debt fund, a low-risk fund like liquid fund or ultra-short-term fund, and from there you transfer a fixed amount at fixed interval. So that transfer can happen every week, it could happen every 15 days, it could happen every month, it could happen every quarter. So what you are doing is that you have a large sum of money, but you don't want to expose that sum of money to the market at that particular moment. So you put that money into debt fund and keep transferring the money. Someone can take the call, let this money with me only, and then I can invest whenever I feel like. It doesn't happen. Because the moment the money lies in a bank account or saving account, either you end up spending the money, or even if you end up spending the money, you see the market level, you get worried. Like last show we did, at that time market was down, but the mood was not very good. And if anybody is invested on that day, he would already have 3 to 4% gain in absolute term. But no, people don't take those kind of decisions at that particular moment. So STP helps you to remove your mood swing and let automatic investing invest in the equity market so you benefit in the long term.
Okay, so let's try and now show people by examples, by mathematics, how an SIP mod would actually benefit you or work for you compared to, say, lump sum investing. That is not to say lump sum investing is bad. Any kind of investing, if it's done, is good. But is there a merit for somebody who's just started to earn to look at the systematic investment plan? The reason why we are talking about a systematic investment plan and a systematic transfer plan. Vijay, if I can just ask you to come here and just talk about some of these numbers for the benefit of our viewers. Maybe you can explain to them what is it or why is it that these numbers would look the way they would. Tiding over the volatility, Vijay, is what we've called them. And this is an illustrative example, Nifty from 9,000 to 9,000, March 2015 to March 2017.
So what has happened that Nifty touched 9,000 in March 2015, then the Nifty went down and then recovered back to 9,000. So from 9,000 to 9,000, actually this number may not be right. In absolute term, it is flat. Okay. But if during the same period you had done SIP, starting from March 2015 till March 2017, you hit close to 10% return.
Yeah, so let's change this number because actually the lump sum return is 0.25% if I'm not wrong versus the SIP return of 9.2%. Now, how did this happen?
Why it happened? Because when the Nifty was 9,000, you invested certain amount of money, fixed amount of money. Then Nifty went down 8,500, 8,200, 7,800, 7,500. So you participated at various level. So average cost of buy for you was not 9,000. It was perhaps 8,200.
Got it.
And that is the reason you got 9% annualized return.
Okay, so this is wrong, of course. Remember, the annualized return is 9.2. The lump sum return is 0.25. Now, we're trying to show, let's move on to the next plate and show you the recovery date. And Vijay will try and explain to you what is the recovery date meaning. Again, Vijay, same example. I mean, what do we mean by this recovery date and why is the recovery quicker if you used an SIP route?
See, this is what we have done is that many people feel scared with the market levels, and that happens every time, whether the markets are high or low. People are always scared of investing in equities. So I took an illustration of, for instance, you look at the peak of the market in January 2008.
Jan 2008, yes, that's the
actually
date.
Peaked. And suppose you invested 1 lakh rupees of money in Jan 2008 on 8 January when the Nifty hit 6,000 for the first time. It closed at about 6,000 level. It took 6 years to get the money back. So 1 lakh when you invested, say in Nifty, when the Nifty went down, the amount also went down. When the Nifty recovered, came back to 6,000 level. It took 6 years for Nifty to come back to 6,000 level.
Right.
So you had 1 lakh rupees. It took 6 years to recover the 1 lakh rupee. Suppose you invested just one time.
Okay, if it was a lump sum investing, the amount would have been recovered only in March 2014. Now, next plate, you will see that if you did an systematic transfer plan, if I'm not
So
wrong.
exactly. So what you've done, instead of investing 1 lakh rupees on 8 January, what you've done, you park this 1 lakh rupees in a liquid fund
Okay,
and transfer 8,333 rupees. 1 lakh divided by 12.
Right.
So you said, I'm going to invest in 12 tranches. So you did that. So you invested only 8,333 at Nifty 6,000. And you did that over the next 12-month period. So by 2008 and you exhausted entire 1 lakh rupees. You've done that since you're not invested in Nifty at 6,000, but also the lower level. Your average cost was not 6,000, was much lesser.
right.
So what has happened that you recover your entire money in July 2009 just in a 19-month period.
Wow. So if you,
Instead of 6 years, you recover in 1.5 years.
so if you're not a market expert, you don't understand the markets too much, which would form a bulk of our viewers as well, retail viewers. And if the markets are volatile, it might be prudent to use, if you have a lump sum amount, use a systematic transfer plan. Or if you don't have a lump sum amount, use the SIP route.
If you don't have money, do SIP.
Simple.
If you have
There's
money,
no alternative.
do STP. And also there's logic. The logic is this, that when the market rise, they don't rise that fast.
Right.
The fall happen faster. So suppose you do STP, what can happen worst case scenario, the market is rising and you're feeling that you're not participating in it.
Right.
But market rise take long time. The market fall take more time. Faster, market fall happens very fast. So suppose you invested at the peak of the market, the fall can be really painful. And what investor end up doing is that they start taking money out when the market falls, the market is about to recover. And that destroys their wealth. I tell you very interesting data. If you look at the history of Indian mutual fund over last 25 years, if you ever invested in any mutual fund scheme and you've not taken money out, you never lost money.
Oh, really? Can
Yes.
you care to repeat that again?
Yes, in last 25 years in Indian mutual fund industry, if you ever invested and have not
At any point of time.
any point of time, and if you have not taken money out when the markets were down, because NAV also went down, but the market recovered, NAV also recovered, you never ever lost money till date.
Wow, that's an impressive statistic.
Yes.
So if at all you needed vindication of investing in mutual funds, this was probably one such more statistic which gave out that.
That's
viewpoint.
why mutual fund is known as the mother of entire financial services product.
Okay. Okay, that's very, very interesting. Vijay, my last question to you for this show, at least today, is a doubt that some people expressed on tax saving funds. And I'm going a bit off,
Yeah, sure.
but tax saving funds, and if people do invest in tax saving funds, they can't withdraw the money within a particular time frame. Now, is that a negative, or would you view that as a positive because your money is locked in for a particular period of time?
Not at all. Actually, if you look at any tax saving product, you have bank deposits with a lock-in period of 5 years. You have PPF with lock-in period of 15 years almost. ELSS is the shortest lock-in product in that category, just 3 years.
3 years.
So it is nothing compared to what, suppose you take tax benefit under house, the holding period is much longer. If you take benefit under insurance policy, the tenure is much, much more longer. So in the entire ELSS 80C product category where you get tax benefit, ELSS is the shortest possible tenure.
Right. Okay. So that's interesting. If you ever had some more questions, feel free to write in to us using the hashtag BQ Mutual Fund Show, and we'll try and get some of those questions answered. I know there are a few questions that have already come in, but due to paucity of time, we can't really take all of those. I just have a graph, a very interesting graph that we made, which shows, to Vijai Mantri's mind, the benefits or the drawbacks of investing versus in lump sum versus the STP. Now, look at this very, very interesting chart, which is on your screen. Investor experiences in market situations. So it's a rising market. Lump sum can give you smiles, and a systematic transfer plan may not necessarily give you smiles. But in a sideways market or a falling market, the smiles are much wider during while if you use the systematic transfer plan. So if you are not a pundit of the market, Vijay, I'm presuming that the advice is, please don't go out and be a hero. Don't try and invest lump sum either in stocks or in mutual funds, use a systematic transfer plan if you have the cash.
Absolutely. Whenever you participate in the equity market, try to stagger your investment. Don't put the entire thing at one go, because you don't touch the water with both feet.
Okay, Vijay, before we let you go, and it's been special the last 2 days to do this educative series with you, for a lot of people who are tuning in right now, who are going to get the Diwali bonus and wondering where within the mutual fund space should they invest these monies into, what should they do? One, should they choose an STP, assuming that the bonus numbers are pretty high, or even if they're not very high, marginally high, should they use an STP with the markets being at 10,000, and why or why not? And are there options in which they can invest, whether through an STP route or otherwise?
If people are getting bonuses or regular cash flows, I think it depends on the time horizon. If they have a 5 to 7 year time horizon, then use STP and invest in equities fund. But if time horizon is 1 year, 2 years, and 3 years, then your debt product. So SIP and STP is not only for equity product, it can be also be used for debt product. So you could have a 3-year debt product where you can invest for the next 12 months or next 6 months or next 3 months. You could have a balanced fund, you could have MIP. So you can use various product, but as much as possible, except in liquid fund and ultra short term, as much as possible, stagger your investment.
Okay, so that's the one advice from Vijai Mantri. If you're getting your lump sum, if you're getting your bonus as well, try and stagger out your investment. Don't try and put all of them in one go. That's the key lesson. But for me, the key lesson was the magic of how SIP or an STP could help you average your cost. Thanks so much, Vijai Mantri, for joining us today and giving us your thoughts. And viewers, thanks for tuning in. Do keep your questions coming. We'll try and get Buckfast Financial Advisory Services to answer all of them over the course of the next few days. Thanks so much for tuning in to the Mutual Fund Show. Today, next week, we tell you all that you wanted to know about investing your Diwali bonus through various routes in the mutual fund industry. Thanks so much for watching.